Jai Hind students. Today I am going to revise chapter 2, that is change in profit sharing ratio of existing partners. And in this revision class, we will revise both the topics. Number 1, methods of valuation of goodwill, and second, accounting treatment in case of change in profit sharing ratio. So let's start the first topic of this chapter, methods of valuation of goodwill. Methods of valuation of goodwill. We have studied there are 3 methods of valuation of goodwill. One is average profit method, second is super profit method, and third is capitalization method. Taking the first one, that is average profit method. How to calculate the value of goodwill through average profit method. Under the average profit method, goodwill is equal to average profit multiply number of years purchased. The formula for calculating goodwill is average profit multiply number of years purchased. Now the question is, what is this number of years purchased? It is generally believed that the buyers of a business gets the benefits of seller's goodwill over certain period of time, over certain years, especially in the initial years. These years are called numbers of years purchased. Now, how to find out this average profit? It's so simple. Average profit is equal to average profit is equal to total profits over years upon number of years. To calculate average profit, we divide the total profits over years by number of years. This way you can find out the average profit. While calculating this average profit, for the purpose of valuation of goodwill, the profit here, this profit should be a normal profit. Normal profit means the profit which business earns through its normal business operation. That is called the normal profit. The profit which is earned by the business through its normal business operation, that is called the normal profit. But in the question, sometime it is given that the profit, there was some abnormal gains. Then what to do? The information provided is that particular year's profit, there was abnormal gain. This abnormal gain is to be deducted to find out correct normal profit. Why we are deducting this abnormal gain. Because of this abnormal gain, profit of that particular year has been increased. So just to make it normal, we are deducting this abnormal gain from that particular year's profit. Similarly, if there was some abnormal loss, what will be the treatment of this abnormal loss? Abnormal loss that is to be added to that particular year's profit. Again, question is why we are adding this abnormal loss? Because this abnormal loss has reduced the profit of the business. This abnormal loss that is not of recurring nature, suddenly this loss reduced the profit of that particular year. That's why for the purpose of valuation of goodwill, we are going to add it. Few more informations you may get in the question, like the closing stock overvalued or the closing stock of a particular year that was undervalued. Then what to do? Like, take the one case. Closing stock overvalued. First, find out the impact of this overvaluation of closing stock on the profit. If the closing stock will be overvalued, definitely profit of that particular year that will increase. That's why to make the profit correct one, we have to deduct it from the profit. In case of closing stock overvalued, this overvalued figure that has to be deducted from the profit of that particular year, because closing stock that we are recording at the credit of trading account, that is the income side, and there we have written a greater amount that resulted increase in the profit, and that's why we are making the profit correct one, and that's why we are reducing the profit with that overvalued figure. But at this point of time, you have to remember one thing, that closing stock of 1 year that becomes opening stock of next year. If closing stock is overvalued in current year, obviously the next year's opening stock will also be overvalued, and because of overvaluation of opening stock, profit will reduce. So in next year, the same amount we have to add. In that particular year where the closing stock was overvalued, we are going to deduct it from the profit, because profit has been increased, and this closing stock becomes the opening stock in the next accounting year, and because of overvaluation of opening stock, the profit has been decreased. That's why we are going to add it in the profit. Take the reverse case. If closing stock was undervalued, think over it. Closing stock was undervalued. At the credit of trading account, you have written closing stock, and that was undervalued. You have written a lesser amount there. Obviously, the profit that decreased because of this undervaluation of closing stock. So what to do? We have to increase the profit of that particular year to make it a correct profit for the purpose of valuation of goodwill. Now again this will have some impact in the next year, because closing stock of this year, one particular year, that becomes the opening stock of subsequent year. In subsequent year, the opening stock again becomes undervalued. And opening stock, where we are writing? We are writing at the debit side in the trading account, the opening stock. And if that there you have written a lesser amount, definitely you are going to get a higher profit. So to make it correct on what to do, in the next year, we have to reduce the profit. Now, few more adjustments may be given in the question. Let's see that also. Capital expenditure. Capital expenditure was recorded as revenue expenditure. You have recorded capital expenditure as revenue expenditure. For example, we have purchased computer and recorded as office expense. Again, think over it, what will be the impact on the profit? You have purchased computer, that is an asset, that should be recorded in the balance sheet. But by mistake, you have recorded it as revenue expenditure, say office expenses. Because of that, since you are recording one expense, you are recording office expense at the debit of profit and loss account. The profit of that year, definitely that will reduce. So how to make it correct? We have to add it. If capital expenditure that is recorded as revenue expenditure, because of the revenue expenditure profit of that particular year, that will decrease. So to make it a correct profit for the purpose of valuation of goodwill, we have to add that amount in the profit. Similarly, if revenue expenditure that was recorded as capital expenditure. Revenue expenditure, that was the expense. And that you have recorded as the capital expenditure. Say repair incurred on furniture, repair expenses. You have spent some money on repair of furniture. As per the accounting rule, repair account should be debited. But by mistake, it was written furniture account debit. It means you have not recorded the revenue expenditure in the books of account. One expenditure, one expense that is missing up from the debit side of the PL account. What will the result on the profit? What will be the impact on the profit? Profit will increase. That's why we have to deduct it from the profit of that particular year to make this a correct profit for the purpose of valuation of goodwill. In both the cases, one more treatment may be associated if the firm's policy is to provide depreciation on these fixed assets. Say here firms want to provide 10% depreciation on computer. Do you think that they have provided the depreciation in this particular case? No. Why? Because they have not recorded computer in their books of account. In the books of account, computer is missing. There is no computer in the firm. How they will provide the depreciation? But now it has been recorded. Now it has been accepted. Yes, there was the furniture, there was the computer. Then you have to provide depreciation. Depreciation in the same accounting year and in consequent year also. So that depreciation is to be deducted as per the instruction, either the straight line method or the diminishing balance method, whatever method that will be given in the question accordingly. And vice versa in another case. Here the capital expenditure that was recorded as a revenue expenditure. The moment you have recorded the capital expenditure, you have recorded that expense as an assets, you have provided depreciation also. So you have to add that depreciation which was unnecessarily deducted from the books, from the profit. This is one case, average profit method. Let's review it once again. Goodwill is equal to average profit multiplying number of years purchase. Average profit means the sum of total profits over the year divided by number of years. The profit, here the profit we are taking, that profit should be the normal profit of the business, which business earns in its normal course of activities. For that, you are supposed to prepare one adjustment table showing correct profit or adjusted profit. That table you can prepare in vertical order or in horizontal orders. Preferably, I personally advise that you should prepare this format in horizontal so that you can add and deduct comfortably. And then abnormal gains, that is to be deducted, abnormal losses to be added, closing stock overvalued, that will be deducted from that particular year's profit, and from the next year, in the next year profit we have to add the same amount. If closing stock was undervalued, then it has to be added in that particular year profit, and the next year's profit it is to be deducted. Capital expenditure treated as revenue expenditure, in that case you have to add that amount in the profit, and if depreciation is there, then depreciation will be deducted in that particular accounting year and in consequent years. At last, revenue expenditure that was recorded as the capital expenditure. In this case, it is to be added in the profit of that particular years, and if depreciation that was already provided, that has to be added back in that year's profit and in subsequent year's profit also. Now, let's start the second method of valuation of goodwill. The second method is super profit method. Through the super profit method, we can also find out the value of goodwill. Now, what is the formula for calculating goodwill under super profit method? The goodwill is equal to super profit multiply again the same number of years purchased. Super profit multiply number of years purchased. That is the formula for calculating goodwill under super profit method. Now, number of years purchased we have already discussed under the head of average profit method. What is this super profit? What do you mean by this super profit? Super profit means the profit which business has earned over the normal profit. And what is the normal profit? That which is earned in the same industry. So super profit, how to calculate super profit? Super profit is equal to average profit. If profits of few years are given, in that case you will find out average profit or actual profit. Average profit or actual profit minus normal profit. Super profit is equal to average profit minus normal profit. Now, how to find out this normal profit? Let's find out. Normal profit is equal to capital employed multiply rate upon 100. Normal profit is equal to capital employed multiply rate upon 100. This normal rate of return that is always given in the question. Okay, this is the rate of return in similar industry which I engage in same types of business operations. There is that normal rate of return that is given in the question. What you have to find out? You need to find out, you have to calculate capital employed. How to find out capital employed? Capital employed is equal to capital introduced by the partners plus reserves, if any, they have created earlier, plus accumulated or undistributed profit if lying in the business. This is the way to find out capital employed. Capital, reserves, accumulated profit. Even in the capital employed, if some current year's balances are also given, that is to be added while calculating the capital employed. There is one another way also to find out capital employed. In class 11th you have studied assets minus external liabilities. If capital reserves and profits are given, then you can find out capital employment by using this formula. If total assets, external liabilities are given, you can find out the capital employed by using the second formula. Sometimes given, just to confuse the students, that assets including stock are including machine worth 10 lakhs rupees. Machine, stock, they are the tangible assets. That will be no effect. You need not to deduct it from the capital. So simply you will take the total capital which includes all the assets, whether they are the non-current assets or current assets, then reserves, then profit. So capital plus reserves and profits, one way to calculate the capital employed. Another way, assets, assets means total assets, non-current assets and current assets, total assets minus outside liability, that is the external liability. Now in this part, one more thing you should remember. Sometime in the question, this goodwill is given. The goodwill of the firm is say 24,000 rupees. Number of years, that is also given in the question. And what you are asked? You are asked to find out actual profit or say average profit. The same question that is given in reverse way. Your approach will be reversed. Say, goodwill, that is given in the question. Number of years also provided. Goodwill 24,000 rupees on the basis of 4 years purchase. I think you can easily find out this average profit. This average profit, what will the, super profit, you can easily find out the super profit. Super profit is equal to what? Goodwill divided by number of years purchased. Goodwill upon number of years purchased. This is a super profit you will get. Now, what is the asked in the question? If it is asked, find out average profit or find out the actual profit, both are same thing. I have explained earlier that if profit of few years are given, in that case, you have to find out average. That average represents the actual profit. If 1 year profit is given, that is the actual profit itself. So, you are asked to find out average profit. This super profit you have calculated by dividing the goodwill with number of years purchased. Now, super profit that is known, you have to find out this normal profit. Again, normal profit, so you can use this formula, capital employed multiply rate upon 100. Then what will be the actual profit or average profit? If you have calculated this normal profit by applying this formula, capital employed multiply rate upon 100, super profit that is known to you, normal profit that is known to you, then how you can calculate average profit? Average profit is equal to super profit plus normal profit. Super profit plus normal profit. Both the way I have explained. If the question is straight, to find out the goodwill, then you will first find out super profit. Super profit is equal to average profit minus normal profit, and for normal profit you are going to find out capital employed multiply rate upon 100, and capital employed you are calculating capital plus reserve and accumulated profits, and finally you will put up this formula and find out the goodwill. If already goodwill is given and you are asked to calculate average profit, in that case first you will find out the super profit. In super profit, goodwill divided by number of years purchased, both the informations will be given in the questions very clearly. Now the average profit, super profit plus normal profit, this will be the formula. Normal profit, if given, that's okay. If not given, use this formula. Normal profit is equal to capital employed multiply rate upon 100. This way, this is all about the second methods of valuation of goodwill. Now, third, the last method of valuation of goodwill, that is capitalization method. Through the capitalization method, we can also find out the value of goodwill. I am repeatedly telling find out the value of goodwill. You know that goodwill is the intangible assets and the exact amount of goodwill you cannot determine, but these are the way. By using these methods, we can estimate the amount of goodwill. Under the capitalization method, there are two ways to find out goodwill. In capitalization method, there are two ways to find out the goodwill. The first one is capitalization of average profit and second capitalization of super profit. Capitalization of average profit and capitalization of super profit. Let's take the first one. Either you will calculate amount of goodwill by using capitalization of average profit or capitalization of super profit. Both the way you are getting the same answer because the method is same, that is the capitalization method. Now in this capitalization of average profit, what to do? First we have to find out capitalized value of average profit. So capitalized value of average profit is equal to what? Average profit multiply reciprocal of rate, that is 100 upon rate. First step is to find out capitalized value of average profit. For that you take the average profit, multiply 100 upon rate. Again I am repeating, this average profit or the actual profit, both are same. Now second, find out the goodwill. Goodwill is equal to capitalized value of average profit minus actual capital employed. Capitalized value of average profit minus actual capital employed. And this actual capital employed, this we have already discussed. When? While discussing the super profit method. While calculating normal profit, capital employed multiply rate upon 100. Similarly, we are finding out the capital employed like assets minus external liability. When I say liability, liability means external liability unless it is clearly mentioned that it is the internal liability. Liability always represents external liability. Or the second way, capital balances, current balances, all reserves lying in the business plus accumulated profits. This way you can find out capitalized value of capitalization method, capitalization of average profit method. Second, capitalization of super profit. Capitalization of super profit, this is the another way to find out the goodwill. It is simple. Goodwill is equal to super profit multiply 100 upon rate. First you will find out super profit. How to calculate super profit? This we have discussed in the super profit method. Actual profit minus normal profit, that is the super profit. After calculating goodwill where after calculating this super profit, we will capitalize it, we will multiply the reciprocal of rate, 100 upon rate, that will be the value of goodwill. Whether you are using this method or you are using this way to find out the goodwill under the capitalization method, the answer remains same. But if you are finding out the value of goodwill by average profit method or super profit method or capitalization method, in 3 different methods you are going to get 3 different answers, 3 different value of goodwill. This is the first topic from the chapter reconstitution of partnership, change in profit sharing ratio of existing partners. And this is very, very important because 3 marks question we always find in the board examination from this topic, and 2 MCQ, that is but obvious from this chapter. Now, one very, very important topic that is left in this chapter, that is change in accounting treatment or accounting treatment in case of change in profit sharing ratio. Change in profit sharing ratio of existing partners. If partners decide that they will share future profits and losses in some new ratios, they are deciding a new profit sharing ratio for future. Remember one thing, that this change that will be applicable after the date of change. It is not applicable on those profits or losses which firm has already earned. In that case, you need to find out after that change which partners has gained, which partners have sacrificed. For that, old ratio minus new ratio. This you can do, old ratio minus new ratio. If this old ratio is greater than new ratio, if this old ratio is greater than new ratio is less than, it means partners, they have sacrificed. If the old ratio that is less than the new ratio, if the new ratio is greater than previous one, partners, that partner have gained. This, which partner have gained, which partner have sacrificed, that you need to find out first, because when we are going to make the accounting treatment of this change in profit sharing ratio of the existing partners, we need this. But remember one thing, again I am repeating, that whatever business has earned, what business has at present, that all related to old ratio. Nothing we are going to do with this new ratio. There is no use of this new ratio except to find out the sacrifice and gain in this chapter. Suppose if there is the reserve lying in the business, profit, that is the PL, credit balance, if that is lying in the business. If there is excess of workmen compensation reserve, after meeting the compensation, some excess amount left with the business. investment fluctuation fund or investment fluctuation reserve. After meeting the loss due to decrease in value of investment, if some amount left with the business, these are the items that needs to be distributed amongst the old partners in old profit sharing ratio, because these things belongs to past, that time the ratio was old. Then what will be the journal entries? General reserve account debit, profit and loss account debit, workmen compensation reserve debit, investment fluctuation reserve debit to all partners capital account. These things to be distributed in old profit sharing ratio. This is one treatment. But if partners decide not to distribute this, they want to leave these items untouched, they do not want to disturb these items, then what to do? These items to be adjusted. It means at this place two options are available. First, distributed in old ratio or adjusted as per sacrifice and gain. Both the options are available. Instructions will be there. Partners want to distribute it, or partners do not want to distribute it. If they want to distribute it in the old ratio. It is always in the old ratio. Don't forget, it is always in old ratio. If they do not want to distribute it, in that case, it is to be adjusted as per the sacrifice and gain made by them. These are the positive items because they are distributed. They are distributed, and when we distribute it, the partner's capital account is going to increase. We are crediting the partner's capital account. There are some negative items. Sometimes it appears in the balance sheet at the asset side. What are these? Like goodwill, advertisement, suspense, and loss, that is PL debit balance. Again, two options are available for this. Either these items to be written off or they are to be adjusted. If you want to write off from the books of account, they are the negative items. Why I am saying it, they are the negative items? Because they are going to decrease the partner's capital. In these cases, partner's capital account will be debited. Like two options are write off in old ratio, this is the first option, or adjusted as per sacrifice and gain made by the partners. Now, if journal entry you are going to write, say A, B, there are two partners, they want to write off these items, they do not want to carry forward in the business. Then A's capital account debit, B's capital account debit, I mean all partners capital account debit, to goodwill, to advertisement suspense, that is also termed as deferred revenue expenditure, some places, some book, to profit and loss. We are debiting partners capital account, resulted the partners capital will decrease. That's why they are, I'm writing it, they are the negative items. If partners do not want to write off these items, they want to adjust it, they want to leave it as it is in the business, in that case adjustment entry will be passed. A normal adjustment entry, if you see, those who sacrifices always credit because he gets the money. Those who gain has to compensate. That partner's capital account is to be debited. But this is a normal case applicable on positive items. In case of these negative items where we are either going to write off or we are going to adjust, for this negative items, if you want to write off, then this will be reversed. Gaining partners capital account debit, sacrificing partners capital account debit to gaining partners capital account. One more thing, that goodwill, valued goodwill, total value of goodwill of the firm, what will be the treatment of that goodwill in case of change in profit sharing ratio. You know that goodwill is never distributed. Accounting standard 26 says if goodwill already appears, it has to be written off, and goodwill cannot be appeared in the books of account unless some monetary benefits has been provided, some monetary consideration has been paid to them. In that case, goodwill here in change of profit sharing ratio, if there is any valued goodwill, there is only and only one treatment, no other options available. Valued goodwill, what? Always adjusted. Always adjusted among the partners. Valued goodwill always adjusted amongst the partners. It is never distributed. It is only adjusted, and for that entry is gaining partners capital account debit to sacrificing partners capital account. Almost I have covered most everything. The accounting treatment for change in profit sharing ratio of existing partners, change in profit sharing ratio of existing partners. For positive items, these two options are available, either distributed or adjusted. If distributed, they are the positive items, capital account is going to be credit, these items to be debited, and partners capital account is to be credited. If the negative items are given, either they will be written off from the books of account, for that entry will be passed partners capital account debit to all these items. That will be again in old ratio, or they will be adjusted. If we are going to adjust these negative items, that case will be reversed. Sacrificing partners capital account debit. Remember, I am repeating it again and again. Sacrificing partners capital account debit to gaining partner when it is for negative items. If all the items are given together in the question and you are asked to find out the adjustment entry, you are asked to pass a single entry. That case, you add all these things, deduct all these negative items. The final amount which you will find, that either will be plus or minus. If that is a plus item, then adjustment entry will be gaining partner's capital account debit to sacrificing partner. If after solving these items, when you are finding a single figure and you are getting a negative figure, that time the adjustment entry, again I am repeating, it will be reversed. Sacrificing partners capital account debit to gaining partners. One and only one topic is left in this whole chapter, that is chapter 2. I am discussing chapter 2, reconstitution of partnership, change in profit sharing ratio of existing partners, which consists two major topics: valuation of goodwill, and second, accounting treatment for change in profit sharing ratio. I have covered almost all the things except one, that is what will be the accounting treatment for revaluation profit or revaluation loss. They are going to change their profit sharing ratio, and that time they are preparing the revaluation account. We have discussed how to prepare revaluation account when I have taught this in the class. So while preparing, when you are preparing revaluation account, either you will get profit on revaluation or you will get loss on revaluation. If you get profit, revaluation profit, then it is a positive item. If you are getting a revaluation loss, then it is a negative item. Treatment will remain same. Revaluation profit, in absence of any specific instruction, it is to be distributed amongst the partners in their old profit sharing ratio. Revaluation account debit to all partners capital account. If there is loss on revaluation, then again it is to be divided, that is to be written off, partners capital account debit to revaluation account, again in the old ratio. You have seen in the entire discussion there was no use of this new ratio. Either we are using the old ratio for distribution purpose, for writing off purpose, or we are using sacrifice and gain. Nowhere we are using new ratio. Only one use is here, that to find out sacrifice and gain, we have to deduct this new ratio from old ratio. And it is not even compulsory that you write this old ratio minus new ratio. Even you can write new ratio minus old ratio. Only you have to see if new ratio that is more, the new share is more, partner is gaining. If new share is less, the partner has sacrificed. Now, one special thing for this revaluation profit or revaluation loss. There is no straight information that partners want to distribute it. Partners do not want to distribute. There is no such information. Indirect information is given to you. Partners decide not to write revised value in the balance sheet. Partners decide not to write the altered value in the new balance sheet. Then what to do? In that case, indirectly you are asked that revaluation profit or revaluation loss that you have to adjust. If it is written in the question, that partners they are going to record the revised value of assets and liabilities in books of account. Then indirectly you are instructed that distribute it, revaluation profit or revaluation loss. So make it a point, just remember it. Now if revised value of assets and liability to be recorded in the balance sheet, the instruction is given that partners want to record the revised value of assets and liability in the balance sheet, then distribute the profit and loss. This profit or this loss on revaluation is to be distributed. Entry will remain same, revaluation account debit to partners capital account or partners capital account debit to revaluation in case of loss. If the another instruction is, if partners do not want to record the revised value of assets and liability, they want to record the previous value, the original value of assets and liability in the balance sheet. In that case, you will not distribute the profit and loss, rather you will adjust the profit and loss on revaluation. This is all about this chapter, reconstitution of partnership, change in profit sharing ratio of existing partners. This chapter consists two major topics. One is valuation of goodwill. Second is accounting treatment for change in profit sharing ratio. This class is going to be very, very important for you. Revise it because generally we find 5 marks question from this topic. Sometimes we may get 8 marks question from this topic. So go through this video lecture, revise it, prepare it. In case of any doubt, feel free to contact me. Thank you and Jai Hind.